Welcome to vTalkInsight Allocator's Lens Daily for December 29th, 2025. Cross-asset markets are closing the year with record equities, surging metals, and a still calm volatility backdrop, even as more voices flag 2026 as a potential inflection point. Let us start with equities, where earnings and artificial intelligence-driven capital spending continue to battle late-cycle risks. In equities, the picture is one of powerful momentum layered on top of increasingly visible late-cycle tension. Global stocks have logged strong gains this year, with a major world index up over 20% and on a multi-day winning streak, while the S&P 500 has notched dozens of record closes. The VIX index sits in the low teens, underlining how calm the surface still looks even as more commentators warn that this benign phase may not last into 2026. Under the hood, several macro tailwinds continue to support a constructive earnings story. Fiscal stimulus, lower oil prices, a softer dollar, and easing trade frictions are all cited as reasons U.S. growth could re-accelerate into 2026, helping both consumers and corporates. Holiday retail sales are estimated to have grown around 4%, topping $1 trillion in volume, with high-income households in particular sustaining spending thanks to wealth effects from record equity markets. Capital spending linked to artificial intelligence is broadening beyond the early leaders, supported by easier financial conditions and multiple fiscal programs, setting up capex as a potential key growth driver next year. Earnings expectations sit at the heart of the bullish equity case. Forecasts point to profit growth of roughly 15% year-over-year, with some strategists penciling in S&P 500 earnings as high as $320 next year. On that foundation, many expect double-digit index gains, driven first by continued strength in an elite group of AI-linked names, and then by a broadening rally into healthcare, banks, industrials, and other cyclicals if the economy avoids recession as the Federal Reserve starts cutting rates. We are already seeing hints of that rotation, with investors trimming exposure to the highest valuation tech stocks and adding to sectors showing improving trends, including healthcare, metals, financials, industrials, and even select basic materials. At the sector level, there are clear winners emerging from these themes. Large U.S. banks have outperformed smaller peers this year, helped by strong capital markets activity and the prospect of a steeper yield curve, with average returns near 40% versus mid-teens for regional banks. Biotech indices have broken to new highs and are flagged as potential momentum leaders into next year. On the growth side, chip makers tied to AI servers such as Micron and hardware leaders like NVIDIA continue to benefit from insatiable demand and constrained supply, with reports of sold-out cloud GPU inventories and record share prices. Meanwhile, under-owned areas like healthcare, commodities, and basic materials are described as undervalued with potential for catch-up as industrial demand, energy transition spending, and inflation themes intersect. Set against that optimism is a mounting concern about valuations and concentration. Index-level multiples are elevated, with substantial good news already embedded in prices, and the largest AI-linked stocks carry particularly demanding expectations. Several voices expect that, even if markets grind higher in the near term, possibly toward levels like S&P 7,200, the backdrop of an election year, policy uncertainty, and extended positioning increases the risk of a meaningful correction or even a bear market in 2026. There's also growing unease that market risk is increasingly concentrated in AI-related equities and associated credits, such that any disappointment in AI monetization or productivity gains could challenge both stock and bond performance despite decent top-line economic growth. Beneath the aggregate data, the consumer and policy backdrop introduce additional downside scenarios. U.S. GDP is expected to slow sharply in the fourth quarter to under 1% annualized, partly reflecting the drag from the government shutdown and softer labor dynamics, including slowing wage growth for lower-income workers. Holiday spending has been resilient, but it is heavily skewed toward the top 20% of earners and lower-income households are already pulling back, with concerns about a postseason hangover as credit card and buy now pay later bills come due. At the same time, business confidence is being tested by a complex and frequently changing tariff regime, which has raised compliance costs and pressure margins, and by uncertainty around future Federal Reserve leadership and balance sheet policy. Together, these factors mean that the high earnings bar for 2026 and 2027 will be closely scrutinized, especially for companies relying on debt-financed AI capex or facing rising input costs from tariffs. For now, the balance of evidence still leans toward a late-cycle but constructive equity environment, powered by earnings growth, AI investment, and ample liquidity. However, the downside scenarios are gaining weight, with stretched valuations, concentrated AI risk, election and trade uncertainty, and signs of consumer fatigue all flagged as potential catalysts for a volatility reset next year. Key watch points include upcoming earnings seasons for signals on capex, discipline, and margin resilience, the sustainability of breadth in a bank's, healthcare, industrials, and materials, and the behavior of volatility as the policy and political calendar intensifies. Those equity dynamics are tightly linked to what happens in rates, where expectations for Fed cuts and a steeper curve are shaping much of the cross-asset narrative. Turning to rates, markets are grappling with a mix of supportive liquidity and unresolved inflation and policy questions. The Federal Reserve has expanded its balance sheet to maintain ample reserves, a move officials frame as technical, yet it nonetheless adds a stimulative element to the overall policy mix. A majority within the Fed is seen favoring rate cuts, and investors widely anticipate a meaningful easing cycle, even as officials remain divided on timing and pace. That combination of expected cuts and ongoing balance sheet support underpins much of the current enthusiasm for risk assets. Against that backdrop, the yield curve is expected to continue steepening. Markets are pricing lower short-term rates as the Fed eventually eases, while robust fiscal stimulus and structural funding need support the case for higher or at least sticky long-term yields. On the inflation side, several disinflationary forces are in play, including an expected decline in owner's equivalent rent, slowing rent inflation in regions with increased housing supply, and the earlier fall in oil prices. However, the same fiscal expansion and liquidity that support growth also complicate the inflation outlook, and there is a recognized risk that aggressive cuts could reignite price pressures, forcing the Fed back in a hiking mode and potentially disrupting the current rally. Policy uncertainty adds another layer of complexity. Markets are focused on the eventual nomination of the next Fed chair, with candidates holding differing views on quantitative easing and balance sheet policy, and that divergence could have meaningful implications for both bond yields and risk assets. Volatility in foreign exchange and interest rates is increasingly seen as a persistent feature rather than a short-lived shock, prompting greater demand for hedging and for services that help firms rewire their supply chains. For multi-asset portfolios, the key questions are how far and how fast the curve steepens, whether disinflation continues to dominate, and how sensitive richly valued equities remain to any upside surprise in real yields. Those rate dynamics feed directly into credit markets, where spreads are tight and select opportunities are emerging away from the U.S. In credit, the tone is one of resilience on the surface, but with rising concern that investors are being underpaid for tail risks. U.S. corporate balance sheets are generally in good shape, with many companies increasing cash reserves both to fund investment and as a precaution, which supports a constructive view on default risk into 2026. Benign credit conditions and expectations for a steeper yield curve are key to the positive outlook for bank earnings, particularly for large institutions where net interest income can benefit from lower funding costs and the repricing of longer-dated assets. At the same time, some of the more interesting credit opportunities are described as lying outside the U.S. The Nordic high-yield market and select Japanese debtor-in-possession financings are highlighted as areas offering attractive yields and relatively strong fundamentals, partly because Japan is shifting away from its historic pattern of corporate cash hoarding. In contrast, structural challenges in the U.S. bankruptcy process, including complex creditor dynamics and high costs, are making distressed credit less appealing domestically than in some overseas markets. Private equity dynamics also play a role, with longer holding periods and subdued deal activity since the rich valuation vintages of 2021 and 2022, but a potential pickup in mergers and acquisitions is anticipated as companies grow into those multiples heading into 2026. The main cautionary notes in credit relate to concentration and underpriced tail risk. High valuations, tight spreads, and elevated geopolitical risks suggest markets may not be fully compensating lenders for downside scenarios, particularly in areas linked to the AI theme, where both equity and investment-grade credit exposure is clustered. Companies investing heavily in AI infrastructure, such as Oracle and other hyperscalers, face rising capital expenditures and margin pressure, and success depends on converting AI enthusiasm into tangible, recurring revenues. On the household side, a projected post-holiday hangover from higher credit card and buy now pay later balances, combined with weakening consumer confidence and slower wage growth at the lower end, could feed through to consumer credit performance if the labor market softens further. For allocators, this is a backdrop where security selection and attention to capital structure, jurisdiction, and covenant quality take on increased importance, while the currency backdrop and commodity trends also influence credit risk premia. Foreign exchange markets are sending a mixed but important signal for cross-asset positioning. The Bloomberg Dollar Index has fallen roughly 8% this year and is expected by some to drift lower next year, a trend that supports higher prices for dollar-denominated commodities and can be a tailwind for non-U.S. risk assets. At the same time, volatility in both FX and rates is increasingly viewed as structural, driven by shifting trade patterns, tariff uncertainty, and divergent central bank policies, which is fueling demand for hedging and for more flexible supply chain arrangements. Within the broader currency complex, crypto assets, and Bitcoin in particular, have evolved into macro-sensitive instruments rather than purely speculative tokens. Over the past 5 years, the advent of regulated exchange-traded funds and institutional-grade custody has made Bitcoin more accessible and credible for large investors, reducing previous operational barriers. Institutional holders now focus on its potential long-term return profile, volatility characteristics, and perceived inflation resistance, rather than on its mechanics, and Bitcoin's price is increasingly driven by macro liquidity conditions, such as government shutdowns or changes in Federal Reserve liquidity programs. Even so, flows are becoming more two-sided. Some large strategies have shifted emphasis from aggressive Bitcoin accumulation toward holding substantial U.S. dollar cash reserves, pausing purchases even during recent price dips, and there is heightened sensitivity around index-related flows and key technical support levels. At the same time, the emergence of gold-backed crypto coins is creating a new bridge between digital assets and physical precious metals, contributing to incremental demand for gold as a reserve-like asset. For multi-asset investors, the key questions are how a softer dollar, structurally higher FX volatility, and a maturation of crypto as a macro asset interact with commodity prices and with the appeal of traditional safe havens. Commodities round out the picture with a striking divergence between metals and energy. Precious metals, including gold, silver, and platinum, have surged to record highs, supported by a weaker dollar, expectations of interest rate cuts, and persistent geopolitical tensions. Central banks in countries such as China, Poland, and Kazakhstan continue to add to their gold reserves as part of a broader move to diversify away from dollar assets, while heavy inflows into gold exchange-traded funds have recently exceeded official sector buying. Gold and silver are also benefiting from safe haven demand as investors look for protection against policy uncertainty, elections, and lingering conflict risks. That strength, however, comes with growing signs of speculative momentum. Silver has posted eye-catching gains, including an 11% move in a single day, and the breakout in the silver-to-gold ratio suggests potential for continued relative outperformance, but also raises the risk of a sharp reversal if sentiment cools. Commentators note that exchange-traded fund-driven rallies can unwind quickly, introducing volatility even in the absence of fundamental shifts. Gold mining equities, such as Agnico Eagle, have outperformed thanks to strong free cash flow growth and rising dividends, providing leveraged exposure to the metal, though valuing gold itself remains challenging given its lack of earnings. Interestingly, gold's store of value status appears to be reinforced as Bitcoin's correlation with risk assets rises, and it behaves less like a classic safe haven. Industrial metals tell a complementary story about growth and the energy and data transition. Copper prices have climbed to record levels, supported by expectations of tighter global supply in 2026 and strong demand from electrification, grid investment, and data center build-outs, all of which are receiving an additional boost from the weaker dollar. Some technical analyses point to further upside of 6 to 7% within copper's current trading channel, and equities such as Freeport-McMoRan and Teck Resources are viewed as potential beneficiaries of this backdrop. At the same time, the rapid expansion of AI data centers is putting pressure on local electricity and water resources, particularly in regions like Texas and Virginia, and is likely to accelerate investment in renewable energy and related infrastructure as operators seek cheaper and more sustainable power. Oil sits on the other side of the commodity ledger, with a more balanced and in some respects disinflationary profile. Prices have recently logged their largest weekly gain since October, driven by partial blockades of Venezuelan crude, U.S. military action in Nigeria, and sanctions-related disruptions to Russian ports, all of which have tightened the physical market in certain grades. Yet despite those geopolitical flashpoints, crude remains contained because global supply is ample, with forecasts pointing to a sizable surplus as the year begins. Technical work suggests a potential stabilization phase, with scope for prices to gravitate toward the high 60s rather than break sharply higher, barring a major new disruption. Energy equities such as SLB and TRGP are showing signs of intermediate-term upside momentum and base breakouts, aligning with the broader theme of rotation away from crowded tech winners into more cyclical exposures. For allocators, how metal strength and contained oil interact with inflation expectations, central bank policy, and sector leadership will be a key cross-asset question into 2026. Stepping back across assets, markets are ending the year with equities near records, a steeper but still low-rate environment, tight credit spreads, a softer dollar, and record levels in gold and copper, all against a backdrop of low-surface volatility. The constructive case leans on earnings growth, AI-driven investment, disinflation from rents and earlier oil declines, and ongoing policy support, while the more cautionary view focuses on stretched valuations, concentrated AI and geopolitical risks, consumer fatigue, and the possibility that inflation could re-accelerate if cuts arrive too quickly. For larger portfolios, the main watch points into 2026 are how earnings and margins evolve as tariffs and wage dynamics shift, the actual pace and communication of Fed easing and balance sheet policy, the resilience of credit as spreads stay tight, the path of the dollar, and whether the current rotation from mega-cap tech toward banks, healthcare, industrials, and commodities continues or reverses. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.